We have just entered year 5 of the global silver deficit. Let that sink in for a moment, year 5. While researching the structural mechanics of this market, I came across a specific data point that made me stop everything and just stare at my screen in disbelief. Global silver refineries are now operating at what is effectively functional zero spare capacity. We aren't talking about low capacity or even stressed capacity. We're talking about a total lack of any remaining room for growth. Every single major refinery on this planet is currently running at its absolute maximum output, pushing its machinery and its people to the breaking point, and yet it still isn't enough to meet the voracious appetite of the modern industrial machine. The Silver Institute has just confirmed a 127 million ounce deficit for this year alone. To truly understand the gravity of that number, you have to put it in a global context. A 127 million ounce shortfall is larger than the entire annual silver production of Peru and Chile combined. These are two of the largest, most established silver-producing nations on Earth, and their total combined output for an entire year still wouldn't be enough to fill the gap between what the world needs and what the world is producing. This leads us to the question that almost nobody in the mainstream financial media is asking. If the refineries are already maxed out, if the mines cannot physically increase their production levels due to declining ore grades, and if the recycling sector is already operating at record high efficiency, where does the silver actually come from? The answer is as simple as it is terrifying. It is coming from the vaults. It is coming from the reserves and the emergency stockpiles that were supposed to last for decades. Those reserves are now draining faster than anyone in the industry expected, and we are rapidly approaching a moment of reckoning. What we are witnessing is the most comprehensive breakdown of the silver supply chain in modern history. 5 consecutive years of structural deficits have broken the mathematical equilibrium of the market, and I don't believe the average investor has any idea what happens next when the music finally stops and the chairs have all been removed. Today, we are going to walk through 3 critical data points that redefine the 2025 silver landscape. Each of these points is alarming when viewed in isolation, but when you look at them together as a unified set of signals, you begin to understand why we are witnessing something completely unprecedented. First, we will examine the refinery capacity crisis, a bottleneck that the paper trading algorithms haven't accounted for. Second, we will break down the mathematics of a 127 million ounce deficit to see why it represents a point of no return. And third, we will reveal the forensic reality of what 5 consecutive years of shortages have done to the world's global inventory levels. By the time we are done, you will see the silver market not as a boring commodity chart, but as a high-pressure system on the verge of a blowout. Let's begin with the refinery crisis, because this is the data that fundamentally changed my outlook. The world's silver refineries are maxed out, and I mean that in the most literal sense possible. When you pull the data from the 3 largest silver refining regions, Mexico, China, and Peru, you are looking at roughly 55% of the total global output. The latest reports show that Mexican refineries are currently operating at a staggering 97% to 99% capacity utilization. In China, the major refiners have reported 96% utilization in their most recent industrial filings. In Peru, the facilities are running at 94%, which is the highest level ever recorded for that nation. In any normal industrial sector, 95% capacity utilization is considered dangerously tight. It means there is no room for error, no window for maintenance shutdowns, and absolutely no capacity to absorb an unexpected spike in demand. If one single refinery in China or Mexico goes offline for even 2 weeks of repairs, you don't just have a delay, you have a full-blown supply crisis. But what makes silver uniquely vulnerable is that you cannot simply scale up a refinery. These aren't just factories, they are complex metallurgical and chemical environments that take 3 to 5 years to construct, require hundreds of millions in capital investment, and need highly trained specialists to operate. That even if a group of billionaires broke ground on a massive new refinery today, the market wouldn't see a single ounce of refined output from that facility until 2028 or 2029. This creates a physical ceiling on the amount of silver that can enter the market, regardless of how high the price goes. The world is consuming more silver than it can mine, and the refiners are the bottleneck that prevents any emergency supply from reaching the end users. This is why the inventories are draining. When a solar panel manufacturer in Shanghai or a semiconductor firm in Texas needs silver, they aren't waiting for new production. They are pulling metal that was refined and vaulted years ago. And that vaulted silver is a finite, non-renewable resource that is disappearing at an accelerating rate. Let's look at the math of the 127 million ounce deficit, because the sheer scale of the 2025 World Silver Survey is hard to overstate. Total global silver demand has officially hit 1.27 billion ounces, while total global supply, which includes both primary mining and secondary recycling, has stalled at 1.14 billion ounces. That 127 million ounce gap is a chasm. To put it in perspective for the skeptics, look at Mexico. Mexico is the undisputed king of silver production, mining roughly 190 million ounces per year. The deficit we are currently running is equivalent to 67% of Mexico's entire annual output. We would literally need to discover another Mexico-sized mining district and bring it to full production overnight just to reach a break-even point. And as anyone in the mining industry will tell you, that is physically impossible. In dollar terms, at a price of roughly $30 per ounce, this 127 million ounce deficit represents $4 billion worth of silver that the market desperately needs but simply cannot find in current production. But the most alarming part isn't the single year number, it's the cumulative weight of 5 years of failure. We saw a deficit of 51 million ounces in 2021, a massive 238 million in 2022, 184 million in 2023, and 182 million in 2024. When you add the projected 127 million for 2025, you arrive at a total of 782 million ounces of cumulative deficit over half a decade. Think about that number. Nearly 800 million ounces of silver have been consumed by the world beyond what was produced during that time. That silver didn't just vanish into thin air, it was pulled out of the vaults of London, New York, and Shanghai, and it was permanently embedded into products. It is in the 5G towers being built across India. It is in the millions of electric vehicles on the roads in Europe. And it is in the massive solar arrays covering the deserts of the Middle East. That silver is gone. It is not investable anymore. It is industrial waste sitting in products that won't be recycled for another 15 to 20 years. Many analysts, myself included, thought that as the price rose, the market would rebalance. We have been taught that higher prices are the cure for high prices, that they would incentivize more mining and bring more recycling to the market. But the data from the last 5 years has proven that the silver market is price inelastic. Most silver is a byproduct of mining for copper, lead, and zinc. If the silver price goes up, a copper miner doesn't automatically dig more ore unless the copper price also justifies it. We have a structural shortage that higher prices cannot easily fix in the short or even medium term. This is a fundamental mismatch between 21st century technological demand and a mining industry that is struggling to maintain its legacy output. Now we have to address what these 5 years of deficits have done to the global inventory levels, because this is the smoking gun of the crisis. If you look at the COMEX registered silver inventory, the metal that is actually sitting in the exchange vaults and available for delivery to settle futures contracts, the decline is shocking. It has fallen from over 150 million ounces in early 2021 to roughly 70 million ounces today. That is a 53% collapse in just 4 years. More than half of the deliverable silver on the largest futures exchange in the world has simply walked out the door. The London Bullion Market Association, LBMA, vaults, which are often seen as the bottomless pit of silver for the Western world, are telling a similar story. The LBMA reported silver holdings of approximately 1.1 billion ounces in 2021. Today, that number has dropped by 300 million ounces, sitting closer to 800 million. That is a 27% decline in the world's most important silver hub, in China. The Shanghai Futures Exchange has seen even more violent moves, with inventories dropping by over 40% since 2022 as their domestic solar industry has basically cannibalized every available ounce of metal within their borders. When you connect these dots, a terrifying picture emerges. Every major vault system in the world, New York, London, and Shanghai, is draining simultaneously. This isn't a regional imbalance. It is a global drain of a strategic resource at the current rate of depletion. The COMEX registered inventory could hit a functional zero within the next 18 to 24 months. Now, the system will not allow it to actually hit zero before that happens. The price discovery mechanism will break. We will see massive price spikes, forced cash settlements, and force majeure declarations. We are heading toward a physical breaking point where the paper price of silver will no longer be able to reflect the reality of the empty vaults. This is a crisis seen from 3 different angles. The refineries are maxed out because the supply chain is under immense pressure. The deficits persist because industrial demand is non-negotiable and supply is inelastic. And the inventories are collapsing because the market is being forced to pull from its savings account just to keep the lights on. And here is the factor that should truly concern every investor. The biggest drivers of silver demand are only just beginning to ramp up. Consider the solar industry. Solar panel manufacturing consumed 161 million ounces in 2023. By 2024, that number spiked to 232 million, a 44% increase in a single year. This growth is being driven by a shift in technology from PERC cells to TOPCon and HJT cells, which require significantly more silver to achieve higher efficiency. Every major government on this planet has committed to accelerating solar deployment. The International Energy Agency projects that global solar capacity will triple by 2030, if those projections are even remotely accurate. The silver demand from the solar sector alone could exceed 400 million ounces per year. That is half of the entire world's annual mine production being consumed by one single industry. Then you have to add the electrification of transport. Each electric vehicle, EV, uses between 1 and 2 ounces of silver in its complex electrical systems and battery management. With global EV production expected to reach 40 million units per year by the end of the decade, you are looking at another 40 to 80 million ounces of new, high priority demand. Then add the 5G rollout, the massive expansion of AI-powered data centers that require massive electrical switching systems, and the medical and water purification sectors. Silver is the indispensable metal of the modern age. It is not substitutable. You cannot use copper in a high-efficiency solar panel without losing the performance that makes the panel viable. You cannot use aluminum in 5G base stations where signal integrity and conductivity are everything. If a substitute existed, these multi-billion-dollar industries would have already switched to it to save money. They haven't, because the laws of physics won't let them on the supply side. The situation is even more constrained than most analysts realize. 70% of silver is a byproduct. This means that silver supply doesn't respond to silver prices. It responds to the global demand for industrial construction and infrastructure metals like copper and zinc. Even if silver went to $100 an ounce, it wouldn't bring a massive wave of new supply because the copper miners won't build new mines just for the byproduct. And the primary silver mines, the ones that do care about the price, are facing a brutal reality of declining ore grades. The low-hanging fruit was picked decades ago. Today's miners have to dig deeper, process more rock, and use more energy just to keep their output flat. The project pipeline for new silver mines is almost empty. There are only a handful of significant projects coming online before 2028, and they won't even cover a quarter of the current annual deficit. So, what does this mean for the price? We are in a situation where a $30 price tag simply does not reflect the physical reality of the market. The last time the world faced structural deficits of this magnitude was the late 1970s. During that era, silver went from $6 to $50 in less than 3 years. If you adjust that $50 high for inflation, you are looking at a target of $150 to $200 per ounce in today's dollars. while markets can stay irrational for a long time, eventually the physical reality of empty vaults overrides the paper trading on the exchange. The Silver Institute itself has used the word unprecedented to describe these conditions. When the industry's own conservative research body uses that word, you know we are in a high-stakes environment. There are, of course, risks. A massive global recession would reduce the industrial demand for silver and provide a temporary reprieve for the vaults. A major shift in government policy regarding green energy could also slow down the demand curve. And we must always be aware of exchange intervention. If the price rises too fast, the COMEX can simply change the margin rules or force cash settlements to protect the big shorts. But none of these risks change the long-term structural reality. The world is running out of silver at current prices. We are living through a fundamental repricing of real assets. For 40 years, investors were taught to ignore commodities and focus on paper assets, stocks and bonds. But the pandemic, the geopolitical shifts in Europe and Asia, and the persistent inflation of the 2020s have reminded the world that real things matter. Things you can touch, things that have physical utility, and things that cannot be printed or manufactured out of thin air are becoming the most valuable assets in the world. Silver sits at the intersection of history, technology, and monetary value. It is in a structural shortage that has lasted for 5 years. The refineries are at capacity. The inventories are draining. The demand is non-negotiable. The math always wins in the end, and the math of the silver market is telling us that a massive repricing is not just possible, it is inevitable.